Hello everyone, and welcome to Unit 9 of our educational series, Stock Investing 101. Our today's lesson has three objectives. First, we'll go over what an IPO is. Second, why do companies choose to go public? And finally, we will be learning the terminology used in initial public offerings. So let's begin with what is an IPO. Before understanding IPO, let's understand the difference between private companies versus public companies. Private companies are owned and controlled by individuals or small groups of shareholders. Public companies are owned by a large number of shareholders who can buy and sell their shares on public exchanges such as the New York Stock Exchange or NASDAQ. As a small investor, you cannot invest in private companies, you can only invest in companies that trade on the stock market. Private companies can launch their IPO and start trading on the stock market. Let's move on to the definition of IPO. An initial public offering is a process by which a private company raises capital by offering shares to the public for the first time. This means that the company becomes a public entity, with shares available for purchase by anyone on the open market. The IPO process, which typically takes 6 months to a year, provides an opportunity for company founders and private investors, such as venture capital funds or private equity investors, to sell their shares and realize a profit. During the IPO process, the listing company collaborates with a team of professional service providers to conduct an audit of the company's financial statements and ensure they are prepared for regulatory review. Align the company's processes and procedures with the requirements of a public company. Prepare a prospectus and work with regulators and public market exchanges to obtain listing approval. Determine the price of the shares, generate demand for the offering, and ultimately list the shares on an exchange. Why do companies launch IPOs? IPO provides an opportunity for the company to raise funds from the public by issuing new shares or selling existing ones. These funds can be used to expand the business, pay off debt, invest in research and development, and fund other corporate initiatives. The primary reasons for IPO launch are trading on the market. By going public, a company can list its shares on a stock exchange, allowing investors to buy and sell its shares on the secondary market. Raising capital from the public. An IPO is a way for a company to raise significant capital by selling shares to the public, which can be used to fund growth, invest in new projects or acquisitions, pay off debt, or for other purposes. Liquidity for existing shareholders. Going public can also provide liquidity for existing shareholders, such as founders, employees, and early investors, who may be able to sell their shares on the public market. Brand recognition. An IPO can increase a company's brand recognition, as it generates media attention and can help to position the company as a significant player in its industry. Customer acquisition. Going public can also help a company to acquire new customers, as it can use its increased visibility and credibility to promote its products or services. And finally, investors' trust. By going public, a company can build trust with investors, as it is subject to regulatory oversight and must disclose financial information, which can help to instill confidence in the company's operations and management. Now we understand why companies launch IPO, let's talk about the terms that you will hear in your everyday life. Understanding the specific terminology used in initial public offerings is essential for investors. Here are key IPO terms to be familiar with. Common stock, units of ownership in a public company offered for sale during an IPO. Issue price, the offering price of IPO shares to investors. Lot size, the minimum bid quantity in an IPO, with bidding in multiples of the lot size. Preliminary prospectus, a document disclosing company information, also known as the red herring. Price band, the range for bidding on IPO shares, set by the company and underwriter. Underwriter, the investment bank manages the IPO, determines the issue price, and allocates shares to investors. Overall, an IPO is a significant event for a company, as it allows it to access public capital markets, increase its visibility and credibility, and potentially raise significant amounts of capital to fund its growth and expansion. Thank you for watching. We hope that this lesson gave you great insight into IPO. To dwell more into the world of investments and become a terrific investor, we suggest you stay tuned for more updates. Let us know in the comments if you have ever invested in an IPO. Leave a thumbs up and subscribe to our channel for more exciting investment related content.